Robert, there's a lot of different solutions when it comes to being able to make a buyer afford a property. You know what one of them is?
Tell me,
Well, in this episode of Real Estate Chat with
John de Perez.
and Robert Eade, we're going to be talking about in Quebec, realtors report increase in buyers assuming the mortgages of sellers. Robert, you're the one who sent me this article. Why don't you tell us what's going on here as far as this new, I guess, relatively new practice that some have not heard of called assuming sellers' mortgages? Like, how does that even work?
Well, they're calling on the expert who has been in the business since 2008. And there's been an observation that properties that have an existing first mortgage on them for, 50% of value at a lower than today's rate are, number one, in demand, but also number two, the buyers are assuming those mortgages in order to take advantage of the lower rate than they can get today. Now, if they've got cash to make to the difference, bonanza. And the only caveat, the only tricky part is that the incoming buyer has to qualify under today's standards to assume the mortgage. And if it frees the previous owner completely from any further responsibility, once the assumption of that mortgage is done by the buyer coming in, then it's great. Now you're free and clear from your property. Somebody else takes over your loan, and they have got a way of beating the current rate of interest by buying something that has an existing lower rate on it. Now, the reason this is a new, eye-opening, let's make an article about it, is because for the last little while, interest rates for a new buyer were better than what the existing person had. So you said to the existing one, get rid of that, take that wherever you want to go. And that same scenario does play into it. Like if you have an advantageous loan now and that you could use in the future, then maybe you're going to do something we call a blend and extend, which I'm not going to get into right now. But there's many ways of dealing with existing first mortgages that cost money to discharge, so you don't want to pay that discharge fee, and you take it with you. Portable is one word. Blend and extend. You take it for a longer time. You blend it with a new amount of principal. Lots of things you can do. But in Quebec, which is where the study was, it's happening everywhere. If you've got an existing first mortgage that somebody thinks is at an advantage, it causes your house to be more desirable for someone who has enough money to come cash too. If they don't have cash available to come and meet your mortgage, then you got to come up with a little more brain scratching on how to make the difference, because you go and get a second mortgage, you compel them to get a second mortgage. It's ridiculously expensive. They might be better off to refinance. So here I'm talking about the million possibilities, but this is exactly why today's market is so much more than it ever was before, where it was just get a mortgage from somewhere, put down your down payment, cash to the seller, next one. You don't even consider the financing. So a lot of relators, as we mispronounce it in the United States, do not know what a vendor take back second is, do not know what a wraparound mortgage is, do not know what an umbrella mortgage is. Is it the same as as a wraparound, or is it different? And never, because they never came up. It was just get a new first, and that's it. It's only, was it high ratio or not high ratio was the only question. So it's fascinating that this is now something that's being discussed 2 years after you and I first brought it up.
Well, there you go. And it seems to be a very sophisticated way of putting financing together. So Real Estate Chat viewers, make sure you subscribe so you're always informed about all of these things. Now, is it like, I mean, first of all, are we seeing this in Ontario happening? And secondly, Robert, is this similar to like assigning a mortgage? Because the proper word, I guess, is assume, but the concept that you brought up earlier, let's say, for example, it's $1 million house today.
Yeah.
And let's say that the mortgage is $500,000. Let's just be a
Yep.
concern.
Yep.
So you're 50%.
Yep.
Let's say I have $200,000 to sell my house.
Mm-hmm. Yeah.
So I'm still behind by 300,000. And you're suggesting that I either cough up that 300,000, I'll ask my bank mom and dad or whoever, or I could, get a second mortgage, but as you said, it's going to be higher. do you think in some situations that first mortgage holder would say, hey, you know what, we'll give you that extra 300,000 from this 500. Well, inflate this mortgage to back to 800,000 and you come up with your 200,000, which you have your down payment. Will that even happen? Or like, what's the solution for if I don't
Well,
have that money?
of course, that's called a blend and extend, which the seller can do, port it and blend and extend, or if you knew what the terms of the existing mortgage were, and you're the buyer, you've got 200, it's $1 million property, there's existing 5 at an advantageous rate, but you need 3 now from somewhere else. So let's say it's the Bank of XYZ. The Bank of XYZ, you go to their mortgage department and say, okay, I've got a fantastic job. My other spouse has got a fantastic job where we're more than well qualified. What we'd like to do is borrow an additional $300,000 from you on the same property, but we want to assume the 500 and get a little bit more at today's rate. And then we'll just blend the rates together as so we'll have a new 800 for like a combination blended rate. Sure, you can do that, but you got to know what the particulars are. If you look at a listing today, there's very few listings that particularize existing first, so many thousands of dollars at certain rate, payment of, up for maturity date of this why, because they think that it's not important to the incoming buyer.
Well, that's the interesting thing. So I want to point that out. And this is for our real estate chat viewers who are real estate agents and practitioners and realtors and registrants. The MLS fields, at least in Toronto, have those fields. I guess they're optional now. But Robert, when you were practicing, was this something that was filled out by a majority of realtors at that time?
It was thought of as a mandatory field because you want to know what the existing financing is, because based on the existing financing, you know a little bit about the seller. So if you're dealing with the buyer, you want to know your adversary. You want to know who you're dealing with. What can you play with? And many, many times, someone who's a last-time seller, you're going to take them off the hook from their existing mortgage. Maybe they're finding it difficult, but it's okay for you. Maybe they lost their job. Maybe they've got a break blank. Who knows? They're finding it difficult. And maybe they'll even help you out with the 3 and the 3 that you don't need. There's all kinds of things that can happen because it's not bricks and mortar. It's a person and their life and another person and their life that's going to solve their problem by giving the money to take over the property. So you're right. It should always be on there. If you're going to port it, it doesn't have to be on there. If the seller's going to take it with them, but the seller is maybe losing out on an opportunity with a buyer who's looking for the existing financing, will pay more of a premium than the value inherent in that low rate mortgage to the seller who's buying something else. But you can only guess about those things without knowing the particulars.
Well, there you go. So it's an opportunity to have some creative solutions to financing based on current situations of the seller. Thanks for watching this episode. Now make sure that because we are talking about financials here, make sure you consult with a professional before attempting or following any of these ideas. Robert nor I are suggesting you do them. We're just giving you ideas in terms of what's available as options out there. Make sure you consult with your mortgage broker, accountant, financial advisor, lawyer, your mom, your dad, your friends, your family, loved ones, and of course,
or make it conditional upon the satisfactory arrangement of that financing.
There you have it.
Describe.
Put that condition in there. Thanks for watching this episode of Real Estate Chat. Take care and bye for now.
See you later.